clearly, if you wanted to make the most money over the last very short period of time, what you needed to do is you needed to be invested fully in stock markets with just taking the ride, because it's been such a good ride with markets. Now, having been advising for 25 plus years, and you've been investing for a long time as well, we've seen cycles come and go like that. But inevitably, if you have a portfolio that isn't investing in everything, then it's got to invest in something. And as you say, that something's going to be narrower. So how do you optimize a portfolio so that if you've excluded an entire sector, let's take any of them, so let's take tobacco or fossil fuels, the fact that you've taken that sector out means you're missing the performance from that sector. So what do you then have to do with the rest of the portfolio to try and make sure that you're not missing out on all of the market upside?
I mean, that's a great question. So if you think about tobacco, usually these are companies that pay high dividends. So these are companies that we define in our industry as relatively defensive businesses. So it means that if you're taking this sector out, then you need to find other companies or other sectors within your investment universe that will provide you the same defensiveness and high dividends that you're looking for. With fossil fuel will be something similar, is that this is usually quite a cyclical industry. So can you find within your investment universe all the sectors or type of companies that will be quite cyclical and with some, correlation to, for example, commodity prices.
Okay. So in essence, if I've understood you correctly, the things that you're excluding, you're looking at the characteristics of those companies, and then you're trying to find other companies that you can invest into that have got those same characteristics, just to make sure you've got the balance correct in the portfolio. Is that right?
Yeah, absolutely right. And I think this is a bit of a different approach for the whole industry than maybe a pre-COVID point of view. And that, I think, is a lot to do with the experience we've had in the past 5 years of that kind of performance divergence that was either in your favor or going out of your favor. And that has led some clients to, to not fully understand why the portfolio was not generated exactly what a traditional portfolio was, or even close to. So I think that the whole industry has really reflected back on that and said, okay, we need to make sure our portfolio we design in terms of, if you want, in terms of its characteristics are close enough to a traditional portfolio, so that if a client has a bit of a traditional portfolio, has a bit of a systematic portfolio, then if you're on the journey that those two portfolios will follow, won't be too dissimilar.